welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Phil Mackintosh, Chief Economist at Nasdaq, to discuss what economists and markets are thinking in terms of the direction for inflation. And Phil, you know what? Economists and markets, they might sound like they're intertwined, but they are two different animals at the end of the day. And before we get there, let's get a weekly review. Stocks have started off relatively strong for the year. What are your thoughts around that? And, you know, rate hike coming up in another week or two.
Yeah, stocks have had a pretty good start to the year. Most of that's actually because we've had some weak data, which was good for the markets. And so we've had the stock market go up. The last couple of days it's come down a little bit just because there's been some more weak data that sort of worries the whole market that the economy might really be slowing down. But the good thing about that is interest rates are also coming down. And so that means longer term, less headwinds for stocks.
Right, and let's take a look at your second chart here because that is regarding Fed rate hike. What are the expectations around that?
Yeah, so you can really see the two jump functions in that chart too are the two big news items that came out at the start of the year. The first was the jobs reports, which were weak, and so obviously that means the Fed can worry a little bit less about wage inflation. And then the real inflation number came out, which was also way down on where it has been. So we hit 6.5% inflation, 6 straight months of that coming down. Remember when we hit 9.1% inflation and the Fed was worried about catching up and raising rates. So now that we're sort of slowing down on the inflation front, the Fed can start to look forward and see what's going to happen to prices, how much more does it need to raise rates, because they're at 4% already.
Right, well, let's move on to your next couple of charts here with a deeper dive into inflation and the contributors that are going into these numbers.
Yeah, so like we said, inflation's coming down. That's the orange line in the chart, and you can see most of the components are also starting to come down too. And so if we look at the month on month, we're actually starting to get some deflation in the numbers. So you think about oil prices and gas prices. When the Ukraine war started, they spiked up. They're now well below where they were. So that's pulling prices down, not just rising less quickly. So we're starting to see that come through almost all the components except for housing. And so that's the one component the Fed's probably still watching. And that's the only thing that's really holding inflation up at the moment.
And if we move along here, let's talk about, you know, what economists think and what the markets are thinking in terms of where inflation might be going here.
Yeah, so because everyone's watching housing, if you think about the house prices, if you're watching house sales in your suburb, like actually you've got house prices falling because interest rates and mortgage rates have got so high. You're also starting to see rents coming down just because the economy's slowing a bit, jobs are slowing down, and so the Fed thinks that the housing prices will come down too. And so economists and the market are both expecting inflation to come down quite a lot during this year. A lot further from 6.5 down maybe below 3. If you look at what the market thinks, it thinks we're going to get below 3 in the middle of the year. If you look at what the Fed thinks, it's by the end of the year. But either way, getting below 3% with current rates at 4%, that's a big change. So we've got a positive interest rates.
And we can see that actually in our last chart here. We can see where that's illustrated in terms of what the Fed thinks and what the market is thinking. And I was surprised to see that it really wasn't that different. I thought there would have been like a bigger, you know, bifurcation there.
Yeah, it's all about the timing though, isn't it? So if the market thinks rates are going to get below 3% in less than 6 months, we could actually see the Fed turn around and cut rates. And if you look at the interest rate futures, that's what the market's pricing actually, is that the Fed will get to maybe 4.5%, nearly 5% soon, and then we'll be seeing rates getting cut by the end of the year. Whereas the Fed doesn't think that. The Fed thinks they're going to get to 5% and hold it all the way through next year. So
yeah, well, it's interesting when you talk about inflation here. Yes, I know house and rents are coming down, energy is coming a bit, but I'll tell you anecdotally, food and everyday cost of living, I feel is exceptionally high. Like I have not noticed anything in terms that's deflationary in those numbers, and that's what people really care about and deal with day to day. You don't buy a house every day, but you have to eat every day.
Yeah, there's been a few problems and hiccups in the food side. So there was some bird flu, which caused eggs to get more expensive. I mean, obviously some weather problems that are causing other farming products to be in shorter supply. The Florida orange crop is really weak. So it's kind of a supply side problem that's causing those inflationary impacts. And hopefully the weather improves and we get the supply to come back up. That can be shorter term. That's why they actually look at core inflation, ex food and energy, because the food and energy can be affected by supply and demand much more short term.
Appreciate the insight as always, Phil. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.